In this video, I'm going to give you some extra value. I'll start with what you clicked for, which was exactly how to do the backdoor Roth IRA. Then I'll explain 3 different scenarios of the best way to invest in that Roth IRA, because you absolutely should invest different in this account since it's the most powerful investing account that you have. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. Remember that all investing carries risks, so do your own research. This is not financial advice, and I'm not a financial advisor. Now first, 2025 is almost up, so you want to get this account maxed out if possible. The max for someone under age 50 in 2025 is $7,000. The max for someone over age 50 in 2025 is $8,000. In 2026 though, that amount's going up. It'll be $7,500 for those under 50 and $8,600 for those over 50. Now this account is the only account where you get to add money in right now, let it compound and grow like crazy, and then all that it grew to is totally tax-free, literally 0 taxes later. And I work with a lot of retirees and they have to deal with these things called required minimum distributions, or RMDs. The amazing thing about this account is that there's 0 RMDs ever. Never. You'll never have to deal with them. The only problem though is that the rules state that you must make under $165,000 if you're a single filer, or less than $246,000 as a household to be able to add to the Roth IRA. But here's the secret that multimillionaires have been using for a while now. And this is how I've been adding to a Roth each and every year. Introducing the backdoor Roth IRA. So basically you can't add to a regular Roth IRA through your bank account because technically that's the front door. If you're filing single and make under $165,000 or less than $246,000 as a household income for married filers, then you can do the front door normal way. But for those of you that are higher income earners and are above that threshold, you have to use this thing called the back door. And this thing is incredibly simple. Almost too simple, and 100% legal. So here's how to do a backdoor Roth IRA, simple step by step. Step 1, you do need to open a traditional IRA. So you'll have a traditional IRA open and a Roth IRA open. So after you open up that traditional IRA, then you're gonna deposit up to the yearly limit, $7,000 for under 50-year-olds and $8,000 for 50 plus. I recommend adding all the money all at one time, because any amount of money that's sitting there, it's gonna start accruing interest if it's in a money market, and at that point it starts getting complicated. So what you're gonna wanna do, or at least the way that I do it, is I get all $7,000 invested in all at one time. When you do invest it, do not take a tax deduction for this contribution. That's why it's a non-deductible. This keeps the contribution clean so it can be moved to a Roth without tax complications. So now step 2, you're just gonna convert that money that's sitting in the traditional IRA over to the Roth. Most brokerages let you do this with one click, like Roth conversion. Ideally, you're gonna wanna do it soon after contributing before the money grows so there's little or no tax. So literally the way that I do it is I get that $7,000 in from my bank account into the traditional IRA. I wait for that cash to settle. It usually takes 3 days or so. As soon as that settles, I just click transfer. On my account, it says transfer. On some of them, it says something like Roth conversion. But all I do is transfer it from the traditional IRA over to the Roth IRA. Boom, that's the back door. But there is an important rule to remember, and this is the pro rata rule. This is the most misunderstood part. The IRS looks at all your traditional SEP and simple IRAs combined when deciding how much of your conversion is taxable. If you have pre-tax money in any IRA, the conversion becomes partly taxable. So some workarounds that some of my clients are using, you may want to roll that pre-tax IRA money into a 401k if your plan allows it. For the most part though, keep your IRAs empty except for the backdoor contribution. I sometimes have clients who hear about this idea of doing the backdoor Roth IRA and then they have money in a 401k and maybe they're leaving that job, so they're thinking, all right, I'll take that 401k money and I'll move it to a traditional IRA so that I have more options of what to invest in it. If you do that, now you have money in a traditional IRA, and so when you go to do the backdoor Roth later on in the next year or something, you're gonna run into that pro rata rule, and that's gonna be an issue. So it might be a good idea to keep the money in the 401k until after you do the backdoor or whatever. Just keep that in mind. Now, the last step for this backdoor Roth IRA is done at tax season. Every backdoor Roth requires the IRS Form 8606 to track the non-deductible contribution, the Roth conversion, and then the taxable amount, usually zero if you did it correctly. Most tax softwares handle this pretty easily, but I recommend having a CPA. I know that my CPA just makes sure everything's clean when it goes through, but it's a pretty easy form to file at that point. And you do need to file this each year that you do the backdoor Roth IRA. So remember, for 2025, if you're under 50 years old, the max you can put in is $7,000. If you're over age 50, the max you can put in is $8,000. And you actually have until April 15th, which is tax day, to contribute for the year prior. So you have up until April 15th of 2026 to contribute for 2025 if you want to, but I'd recommend getting it done as soon as possible. And remember, when you put money into the Roth IRA, it's just sitting there. It's just like a bank account or something. It's just sitting there until you go and actually invest it. So now, what should you invest in within the Roth IRA? I get this question all the time, so let me give you 3 very solid options. First would be to use it for its absolute superpower. Remember that anything that you put into the Roth has already been taxed and will never be taxed again. So it grows tax-free, and specifically the dividends that you receive in it have 0 taxes. One of the best ways to be able to build generational wealth or to build passive income forever is by putting together a fund of solid dividend assets. Because dividends are amazing, but if you have to invest in them in a taxable account, then you're getting taxed every single time that the dividend hits, even if that dividend's going right back into the fund. So if you want to take part in one of these cool dividend ETFs or something that's giving you 10%, maybe 15% dividends, they're usually going to be taxed at your income rate. You're going to be taxed in the high 20s, possibly 30s% for this dividend, and that's not worth it. But if you have it in a Roth, you could literally build that thing up and it could produce a tax-free income forever, where the principal stays the same or even grows, but you never touch it because you can live off the dividends alone. Like if you invested in QQQI in your Roth IRA and you have just $500,000 in there, the dividend on QQQI currently is at about 14% per year. So this would give you yearly dividends of $70,000 or almost $6,000 every single month, 100% tax-free forever. Obviously, it wouldn't be the smartest thing in the world to put all of your investing amount into one ETF or one single stock, which is why I put together this course that gives you literally everything you'll ever need to invest in dividends and become a dividend master. There's so much information out on YouTube and even videos that I've made or other people have made, and it's all good stuff, but it's just so hard to find and there's so much noise out there. This course has 17 videos that are easy to follow and cut out all the fluff. You'll always be able to access them to help you with picking the best choices for your portfolio. This course is normally $129, but I made sure to put it on sale for a limited time for only $79. Click the link down in the description, and honestly, this would make a great holiday gift for someone in your family as well. So even if you understand dividends, grabbing this for a loved one and gifting this to them might be the gift that just keeps on giving. Okay, so scenario number 1 was using that Roth for its superpowers to do dividend investing. Scenario number 2 now uses it for its other superpower. You all have seen the charts and compound interest calculators where if you just invest $500 at 10% return for 40 years, it could turn into $2,655,555. And that's absolutely true. Those numbers are actually accurate. But the key to that is compound interest and time, which equals monster growth. So for this scenario, you could add in a bunch of solid growth ETFs like SPMO, QQQM, VGT, SMH, and even IBIT for some Bitcoin. If these things keep growing the way they have in history, this account will have some serious compounding. Now just keep in mind, if you want to make this account a bit more risky, then it's probably smart to have the 401k or brokerage accounts or different other places have a little bit more value and maybe foundational style ETFs, just so that you're balanced in all places. I would never recommend going fully growth in all of your investing. The third option is the one that's going to be very familiar to all of you if you've been following this channel for any period of time. This is the most balanced way to invest, and it's going to get you the best of both worlds while you're going to be able to get very high highs, but make sure that your portfolio is protected in any type of downs. This one here is my new 3-fund portfolio, which uses a foundational ETF like VU, a safer but maybe dividend style ETF like SCHD, and a growth ETF like QQQM to build quickly and simply. To learn more about this strategy, watch this video where I go over not only all the different types of ETFs that you could invest in there, but also the exact percentages based off of your age, because it does change with your age. Or watch this one to keep you going strong in investing. Remember to keep investing simplified.